Hey finance virtuosos! Today we're diving into stock market sectors and how understanding them can seriously level up your investment strategy. This knowledge is key to building a smarter, more balanced portfolio whether you're new to investing or looking to refine your approach. So, let's break it down in a way that's easy to grasp and maybe even a little fun. This is the Finance Virtuoso channel, where we talk about all things finance. If you're new here, be sure to subscribe and hit the notification bell so you don't miss out on any future money tips and tricks. First off, what exactly are stock market sectors? Well, think of the stock market as a big mall, and each sector is like a different department store. Just as you'd find clothes in one store and electronics in another, different types of companies are grouped into different sectors based on what they do. According to the Global Industry Classification Standard, there are 11 main sectors in the stock market. Let's run through them real quick. 1. Materials. 2. Industrials. 3. Financials. 4. Technology. 5. Consumer discretionary. 6. Consumer staples. 7. Energy. 8. Healthcare. 9. Communication services. 10. Utilities. 11. Real estate. Now, here's where it gets interesting. These sectors aren't just random groupings, they tend to behave differently depending on what's happening in the economy. This is where we get into the concept of cyclical, defensive, and sensitive sectors. Cyclical sectors are like fair-weather friends of the economy. When times are good, they're thriving, but when the economy takes a nosedive, they tend to struggle. These typically include materials, industrials, financials, technology, and consumer discretionary. Some folks also throw real estate into this mix, but that's up for debate. On the flip side, we have defensive sectors. These are the steady eddies of the stock market. They deal in products and services that people need regardless of how the economy is doing. Think consumer staples, healthcare, and utilities. These sectors might not give you massive gains when the economy is booming, but they're less likely to tank when things go south. Then we have the sensitive sectors, which are kind of like the Goldilocks of the stock market, not too hot, not too cold. They're affected by economic changes, but not as dramatically as cyclical sectors. This group often includes industrials, technology, energy, communication services, and sometimes real estate. Now, let's get into the nitty-gritty of each sector. I'll give you a quick rundown of what they do and how they've performed historically. Remember, past performance doesn't guarantee future results, but it can give us some interesting insights. The materials sector is all about raw materials, think plastic, lumber, chemicals. These are the building blocks that other companies use to make products. Companies in this sector have been pretty dependable investments historically, bouncing back well from market bottoms. Moving on to industrials, this sector covers a wide range of industries from aerospace to machinery to transportation. It's been a solid middle-of-the-road performer, not standing out in any particular metric but also not really struggling in any area either. The financial sector, as you might guess, deals with banking, investments, and insurance. It's known for being pretty volatile. When times are good, it can give great returns, but when the economy tanks, it can really feel the pain. Next up is information technology. These are the companies creating software, hardware, and semiconductors that drive our digital world. Tech stocks can be a wild ride. They've shown some of the highest growth potential but also some of the biggest drops during market downturns. Consumer discretionary covers companies selling things we want but don't necessarily need, think retail, restaurants, and hotels. Interestingly, this sector has shown some of the best returns since 2000, but it can be hit hard during economic downturns when people cut back on non-essential spending. On the flip side, we have consumer staples, companies selling essential goods like food and household products. This sector tends to be pretty steady, with lower volatility than most other sectors. The energy sector, covering oil, gas, and related services, has been a bit of a mixed bag. It's shown some impressive short-term gains at times but has struggled with overall growth since 2000. Healthcare, covering everything from pharmaceuticals to medical equipment, has shown strong growth with relatively low volatility. It's considered a defensive sector because, well, people always need healthcare. Communication services, which includes telecom and media companies, has actually struggled a bit with growth since the early 2000s. But remember, past performance doesn't predict future results. Utilities, covering power and water companies, has shown surprisingly strong growth figures with relatively low risk. It's another defensive sector that tends to hold up well during economic downturns. Finally, we have real estate. This sector has shown the lowest volatility of all sectors since 2000, with steady, if not spectacular, returns. Now, here's my unique take on all this. While understanding these sectors is crucial, I think it's equally important to look beyond them. The lines between sectors are becoming increasingly blurred in our modern economy. Take Amazon, for example. It's classified under consumer discretionary, but it's also a major player in cloud computing, which you'd typically associate with the tech sector, and has its fingers in everything from groceries to healthcare. Or consider Tesla. Is it a car company, consumer discretionary, a tech company, or an energy company? My point is, while these sector classifications are useful, they're not everything. As an investor, it's important to look at individual companies and understand their unique positions in the market. Another thing to consider is the global nature of many of these companies. A US-based multinational might be affected more by economic conditions in China or Europe than by what's happening domestically. So, how can you use this information in your investing strategy? Well, understanding these sectors can help you diversify your portfolio. If you're heavily invested in cyclical sectors, you might want to balance that out with some defensive stocks to smooth out your returns during economic downturns. You can also use this knowledge to make tactical decisions based on where you think we are in the economic cycle. If you believe the economy is about to boom, you might lean more heavily into cyclical sectors. If you're worried about a recession, you might increase your allocation to defensive sectors. But remember, timing the market is notoriously difficult, even for professional investors. That's why many experts recommend maintaining a diversified portfolio across multiple sectors. One approach you might consider is core and satellite investing. In this strategy, the core of your portfolio, say, 70 to 80%, is broadly diversified across all sectors, perhaps using index funds. The satellite portion, the remaining 20 to 30%, is where you might make more tactical bets based on your views of different sectors or individual companies. It's also worth noting that sector performance can vary greatly over different time periods. The best performing sector one year might be the worst the next. This is another argument for maintaining broad diversification rather than trying to pick winning sectors. Lastly, don't forget about international markets. The sector makeup of other countries' stock markets can be quite different from the US. For example, the European market tends to have a higher weighting in financials and a lower weighting in technology compared to the US market. That wraps up our exploration of stock market sectors and how you can use this knowledge to enhance your investment strategy. Remember, understanding these sectors is just one tool in your investing toolkit, but it's a powerful one that can help you make more informed decisions and potentially improve your returns. I hope you found this information helpful and maybe even a little enlightening. If you did, don't forget to like this video and subscribe to the channel for more investing insights. And hey, if you have any questions or thoughts about stock market sectors, drop them in the comments below. I'd love to hear your perspective. Until next time, happy investing.